And of course, we had that inflation data earlier. Markets open fractionally higher. Joining me now to talk more about the data, of course, what is ahead for rates and the Fed is Greg Farinello. He's head of U.S. rates at Amerivet Securities. Greg, it's great to have you.
Good to see you, Kristen. Thanks for having me.
Yes, good to see you as well. So let's start with this inflation data. Actually a little bit better than expected, but still above the Fed's long-term 2% target. What's your read?
So my read is, short-term, better than expected in certain elements. Definitely still above the Fed's 2% target. It's interesting because we have a Fed review at the end of the month, the 5-year review. In 2020, they went to inflation averaging, which turned out to be untimely, if you will, because inflation took off. Now they're probably going back to a mantra of, fighting inflation because of what we've seen over the last 5 years. So my view right now is, inflation is running between 2.5% and 3%. If we stay below 3%, I think the Fed's in good shape. They're focused very much on the employment side of the market, though, right now as well.
Right. Okay. So we did have that disappointing jobs report, obviously, for the month of July, and then significant downward revisions to June and May as well. We're talking about basically in the teens, right? The tens of thousands of jobs actually that was created when it comes to those particular numbers. What does that mean for the Fed when it comes to cutting interest rates?
So what it means for the Fed is they need to balance out their dual mandate, right? So it's employment, it's inflation. The current chair, calls it tension between the two. Where are the two relative to each other? My sense is, in listening to the committee, and we've had some dissension, but it's not just the dissenters. Mickey Bowman and Fed Governor Waller dissented, but if you listen to some of the other Fed members, they are becoming increasingly concerned, I think, about the employment market. So with today's inflation data, and we're going to have a lot more data before September, we're priced, I think, close to 100% for September. We do think the Fed will start coming down in the latter part of the year.
I do want to talk about some of the changes coming to the Fed, right, in terms of the personnel, if you will. It's been a busy week in terms of those particular announcements, and this search that you mentioned is ongoing, of course, for the chair, with Besson adding some new names there. What does Stephen Moran bring to the table as Trump's pick, right, to replace Kugler?
Well, I think he's going to put the heat on Chair Powell, if anything. So he's very close to the president. He's been an architect, I think, of a lot of the policy that we're seeing coming out of Washington. So short term, that will put a little bit more pressure, I think, on Chair Powell. He's a temporary pick, so his replacement will likely be the new Fed chair. And to your point, I mean, it's interesting, right? I mean, a lot of new picks coming into the mix. I mean, it's an interview process, I think, at the end of the day. So, and there are a lot of qualified candidates out there in general. Personally, for us, we would prefer to see someone within the existing Fed or someone who has experience within the Fed in terms of policy going forward, relative to someone coming out of the administration and just being implanted. Yeah.
So in terms of who could replace the Fed chair, does that signal to you that Trump will have his way when it comes to the Fed in the years to come?
Not necessarily, right? I mean, I think it's easy to be construed that way. I do think the president is on the right course in terms of rates coming down in general, but at the end of the day, it's going to come down to policy. And I think if we continue to focus on the supply side of the economy, we keep inflation low, then there's room for the Fed to come down closer to neutral, which we think is probably around 100 basis points from here. But I don't think this is a case necessarily of just, here's my Fed pick, and rates are just going to come blindly down. So,
what does this mean for equities?
I think it's good. I mean, equity markets have come back a lot. I mean, we're well off the April lows. We made new highs. I think if you look at drawdowns like we had in April, historically, we typically do make new highs. We're consolidating here over time. But look, we're still constructive on markets in general. Markets, we think, are in good shape. Volatility has come down. What it means for equities, my view has always been, and we've been doing this for 30 years, so we've seen the zero interest rate policy. We don't mind higher policy at this point. Our view has always been, if we get down to this sort of 3.25%, 3% neutral rate over time, and policy is good, it should be good for equities as well.
Yeah. Greg Farinello, always great to have you in studio. Thanks for joining.
Great to see you.
Yeah, great to see you too. Greg's the head of U.S. rates at Amerivet Securities.